The role of accountants. The success of any business decision is measured by the financial returns the decision births. Thus, an accountant's role in a merger or acquisition cannot be overemphasized because they deal with the money element of the transaction. An accountant will determine, based on the company's financial records, whether a merger or acquisition is a viable option, and if it is, what the best course of action for the company at the time will be, with all the factors considered. An accountant will make sure that the parties involved have similar visions and ethical outlooks. He is also obligated to predict if the goods and services that the parties offer will merge effectively under one company, whether the public is receptive to the change and the financial implications of the transaction. We will look at the role of an accountant in 3 phases, namely the pre-merger or acquisition stage, the integration stage, and finally, the post-merger or post-acquisition stage. In the pre-merger or acquisition stage, the accountant must conduct due diligence and ensure that there is a comprehensive analysis of the company's financial records, assets, and debts. Due diligence procedures will vary with each deal, but the following is a list of some of the typical elements of that procedure. Identify preliminary issues. Prepare and submit data request lists for additional information to the appropriate parties. Communicate high-level issues to the client. Review audit and tax working papers and interview audit partners and tax advisors. Correspond with management and raise any issues that arise where necessary. Update the list of issues and communicate this with the client as well as the implications. Begin to draft a diligence report. Analyze and comment on the client's investment model. Analyze and provide insights on the proposed financial structure for the new company. Analyze and comment on the updated investment model and the purchase agreement. And finally, communicate their findings with the client. In furtherance of due diligence, the accountant must also identify the different tax-related fees and other necessary levies required for the transaction. An accountant will ultimately determine the final purchase price of the company and the financial terms of the merger or acquisition. In order to determine the price, he will have to consider the qualitative characteristics of the company, some of which include the skilled labor force, location and branches of the business, assets of the company, and the debts of the company. An acquiring company can also benefit from economies of scale and synergies that are created due to the acquisition. The accountant is obligated to provide an expert opinion on the appropriate strategy to undertake to consolidate the 2 companies, as well as the best way in which to integrate all the parties involved. The accountant is also obligated to formulate the new managing accounting system for the new company. This plan will guide the management during the post-merger stage or post-acquisition stage. The plan will take into consideration the payment of staff, rotation of staff, provision of amenities, emergency funds, stock versus asset purchase, expansion goals, training and counseling for the staff, and other similar items.